Okay, so Arno, welcome to F.A.C.E. I believe this is the first time that we've had a chance to meet each other. Waiting to hear your voice, buddy.
Sorry, Coach, can you hear me now?
Got you, Arno.
Thank you.
Thank you for joining us. Nice to meet you.
Thanks for having me. Really appreciate it. It's an honor being part of the webinar today.
Okay. Are you going to be showing anything? Because there's a share screen button if you are.
Yeah, sure. Let me quickly just open up a couple of these things we've been looking at.
I've been to your website. Nice. Took a look
at
it.
Coach.
There, you guys have some nice research, some great articles on there, and I'm assuming you're an author of some of those articles. Is that what you do at Financial Source?
Absolutely, Coach. I'm one of the senior analysts at Financial Source. So our main focus point, our main focus is what we try to do is basically, like you've seen with the testimonials about the squawk. We basically have a plugin for a squawk as well as a news feed, but the main value is really the intraday, intra-week analysis. So we've got daily video commentary going around, daily reports, weekly reports, daily webinars, etc. So that's mainly the main add-on, the value add-on, if you will.
Okay. Do you have many people in the US using your product or Europe?
I think so, Coach. I think the majority of them is actually US based. The company we're actually hosting from the UK. I'm in South Africa, but the majority of the team is in the UK. But I think majority of the base is in the US. Okay,
so why don't you tell us a little bit about from point A to point B, how you got started in the industry, what you were doing prior, and what led you to where you are today.
Thanks, Coach. Yeah, I think like most retail traders, I think I started for the wrong reasons at first. So I got pulled into a trading seminar probably about 10 years ago. And it was a group of really good marketers that promised me the world, that I would be sitting on a beach somewhere in no time, just pressing one or two buttons and making millions.
So they didn't tell you you'd be sitting on the beach and you're going to have to sleep there too and get a tent, huh?
They didn't, Coach. They left that part out. So that was a really interesting start. So after those dreams, came tumbling down very quickly. The one thing that stuck around was just a very strong curiosity about the financial markets, and that really started me on a journey of learning as much as I can from as many people and courses as I can. And I probably spent the first 6 or 7 years just focused on the technical side of trading. Really enjoyed that. I always wanted to know why, though. Being very curious and analytical, the why always bothered me. So, seeing something rally for no reason, I wanted to know why the currency was doing that. Why did the market react that way after a hike or a cut in the interest rate, or no hike or cut at all? I wanted to know the why around why the markets was moving.
Did you have any mentors or books or anything that were, kind of not just inspirational, but kind of gave you an epiphany that influenced the way that you're still trading? Any person or method?
Absolutely. I mean, the amount of technical courses that I went through is probably ridiculous. Just endless amounts of technicals. And what actually happened in 2018, apart from the technical side, to try and trigger more of the why, if you will, in the markets, I took part in a 6-month in-house global macro fundamentals course. And suddenly when I started learning about the fundamental side, I just fell in love with it, fell in love with the markets, all over again. Suddenly I felt like I understood and had the skills to understand the why, that thing that's been bugging me the whole time. So I can see the pound is rallying, but why is it rallying? I wanted to know the reasons behind it. And I felt that that is that curiosity just led me to more of a global macro framework. And
okay, let me ask you this, since you did go that way, and I could use a course like that. Guys like Mark Chandler and other, real good Adam Button, they always tell me the why, when I'm just, to me, it's a, RSI 3 drive, all technical. And a lot of my biases are based upon technical. So now that you are familiar with fundamentals, so you get most of your narratives and biases from that, and then wait for technicals to confirm it.
I would say that sums it up perfectly, Coach. I think you can put it down to an 80-20 rule. So I would place 80% of the focus on the narrative or the theme or the macro drivers, and then I would still use the same technical skills, but more from a timing point of view, more from a risk management point of view, if you will. Basically, choosing entry and exit locations based on the technicals, but mainly trading in line with a fundamental rationale.
Okay.
And I mean, sometimes the fundamental rationale can be as simple as, just positioning being stretched. There's so many different aspects. It's not always just driven by news events or macro or monetary policy or anything like that. Sometimes it can be as simple as, hey, we like this thing going up in the medium term, but short term there could be some opportunities to play some mean reversion, etc.
Okay. And what are the fundamentals telling you about the dollar in here? We've had this bounce, the whole market was wrong-footed at the beginning of the year. The whole world was bearish the dollar. And now we kind of have the opposite setup. We've recently pulled back to, a pretty important zone that I have here around 93.5 is kind of like a breakout level. So fundamentally, you would think that most people are bearish the dollar because of all the monetary stimulus, but now we're heading towards taper. Does that make you more constructive on the dollar?
Definitely. I think coming into the year, we had that first massive rally back in February. And I think that was mainly driven by just major offside positioning that we had in the dollar at that time, when we were sitting on such a stretched positioning. So I think that was a bit of a relief rally, if you will, in the dollar. And then, if you recall, from April, we had a lot of that reflation narrative coming back into focus for the markets, and from a global surprise, economic surprise point of view, that saw a lot of downside being priced back into the dollar. Where we turned a little bit more constructive on it was back in early June, before we went through that FOMC meeting back in June. The reason why we turned a little bit more constructive, not necessarily bullish on it, but just not wanting to be shorted anymore, was based on the potential change from the Fed. Eventually, they were going to have to move, acknowledge what's going on from an economic point of view, moving towards tapering. And also for a similar, if we take a look at global surprises, it started to surprise to the downside back in May already. So we started to see, if we take a look at the global Citi Economic Surprise Index, that started to top out around that time. And because the dollar is so closely, correlated to the global picture, the global economy, when that started to roll over, that got us a little bit concerned about wanting to be short the dollar. And then obviously we had the FOMC meeting coming up in June. I think that rattled the cages. I think a lot of the upside that we had initially again was positioning, because we were sitting on, back in May, June, early June, again, we were sitting on huge amounts of net short position being built back into the dollar. So I think after that was flushed out, it's been really driven by Fed expectations. And I'm definitely more constructive on it in the medium term. In the short term, though, I think what's interesting about the dollar is that at the September meeting, the Fed has taken a lot of the sting out of the incoming economic data points. If you take a look at how the dollar reacted after CPI last week, I think that was a good example of them taking the sting out, because now, if we get good data between now and November, it's not going to change the way the markets think about Fed tapering, as well as that mid-2022 conclusion. It's basically not going to change how they think about that. But if we see the data coming in with a miss, or just as expected, with them taking the sting out, already telling the markets what they're going to do, I think the dollar is going to be a lot more sensitive to risk sentiment in the next couple of weeks. And now that we started to see global case numbers also topping out and pushing lower again, there might be some scope for some reflationary data points coming out. Obviously, there's a lot of concerns
is that going to be bullish or bearish the dollar?
I think that's going to be very short term, the dollar, coach, at least running into November. So running into November, I think if risk sentiment can keep up, if equities can keep up the pace we've seen recently, if we get data points that points to more of a reflationary setup, even though it's probably only going to be short term, I think that can add downside for the US dollar, very, very short term, just purely based on reflation. But again, with the Fed taking the sting out of the data points, it's going to be really, really driven by risk sentiment. I think the move we've had over the last couple of hours, I think it's mostly been driven by risk. Equities have been pushing to the upside. We've seen very constructive moves in the high betas and downside in the safe havens. So I think it's going to be more sensitive to risk sentiment. If the Fed didn't come out at that September meeting and acknowledge tapering, as well as already acknowledge a mid-2022 conclusion, I think the data would have mattered a lot more. I think we would have seen the dollar rally on positive data points if it wasn't for that, because the markets would have used that to basically gauge what the Fed is going to do next. And I think now that we know what they're going to do next, it's basically like, it's just taken the sting out of it going into that November meeting.
Okay. Any view on what's been happening with you're from South Africa. You have a feel on what's happening with the miners, which have not really kept up with the bullion. I was always taught that the miners should lead. You have a view on gold and silver having very strong days today?
Yeah, I mean, silver has been such a dog to trade recently. I was actually long silver a while ago from around that 23.40 level. Obviously, that drop in September, I mean, I should actually start a signal service where I sell, where I place my stops, because that's often where the market turns around from. So, I literally had my stop sitting on 21.56. We touched that level, bounced back. So I got back in from 22.15. So happy to finally see silver breaking out of that trend resistance that we've been slamming up against recently. I think the biggest just risk for silver from here, like gold as well, I think it's going to be yields. The reason why I wanted to actually add to silver to that position we've got running, but the thing that just kept me back was the massive monster moves we've seen in yields recently. Personally, I do think it's looking like this is running out of a little bit of steam, at least in the short term, and that could provide further upside for something like the precious metals. But in terms of yields, I think it's going to come down not only just to the inflation outlook. I think there's been a lot of focus on the inflation side, and that's really driven the narrative around yields recently. I think the one thing that's obviously been talking about quite a lot is the stagflation risks in the markets. Yeah. And even though I'm not really in the stagflation camp right now, I think if we do start to see a faster deceleration in growth data coming up in the next couple of weeks and months, if we do see more of a growth concern developing, even if inflation picks up, I think there could be some downside for yields coming up on that front. And I know that's counterintuitive, because normally the bond market's going to be more sensitive to rising inflation and obviously rising interest rate expectations based on that. But if the demand picture completely drops out, if we see demand and growth really taking a big hit, I think counterintuitively that can actually start to lead to downside in yields, upside in bonds. Because if we take a look at the short end and the back end, the short end is normally driven more by policy expectations, while the back end of the curve is normally more driven by your firstly inflation and then secondly growth expectations. So I think the one risk to our medium term like upside bias for yields is that if growth really does decelerate, like some and analysts that are expecting it to, I think that can counterintuitively, even if inflation stays high, could lead to some downside in yields. in the weeks ahead. And I think that should be more of a positive backdrop for precious metals. I think the reason why I like silver more than gold is more from a medium to long-term outlook. So I think the fact that there's so much more industrial applications for silver makes it more attractive from a supply-demand point of view. And with all of the focus in the next decade and possibly more that's going to be turning its attention to the green initiatives, to the to a greener economy, I think there's a lot more applicable uses for silver with solar power, etc. And that should, again, from a supply-demand point of view, mean that it's going to be less sensitive compared to something like gold to the yield environment. And I do like that. But I have to say, I'm a little bit, concerned about the yield outlook. I think we're running into areas for yields where we could start to see some downside playing out, i.e. upside for bonds. But if that doesn't happen, and yields just make a run for it, I think consensus right now sees it going up to, I think, what's it, 2% for 10-year?
Yeah, that's a lot of people have 2 to 210 as a peak, and then after that they're going to sink, and maybe we go to negative rates again. So I've heard that scenario.
I'm not sure whether I'm in that camp right now. I know they say they think 2, but I think we top out before we get there.
There's another area at 168. And at 168, you would have a 3 drive. Are you familiar with that formation?
I am.
3 drives to a top, 3 drives to a bottom. So one more push up towards 168 would kind of would give you, would give you like a 3 drive formation to that it may be peaking out there.
And we're also running into some firm resistance around that level as well. Going back to that range high we were stuck in for a couple of months back in April and May. So I'm just not sure whether we get to 2%. I think if we top out soon, I think that can be even more positive for precious metals. It's a little bit counterintuitive though, because normally precious metals would be more sensitive to tapering expectations, but it's just there's so many things that's not like a normal cycle right now. I'm very wary of pulling too much similarities from previous cycles to this one, just because there's so much that's different this time around.
Okay, crude looks like you're getting a potential failing rally here in crude. I was looking for a high this week. Actually think that then I turn it into my interview. I'm negative here. Do you think that we're getting some type of top, and it was led by this pretty good crash in natural gas over the last couple of days?
Yeah, and natural gas, that was the main instigator of the whole gas to oil narrative a week or so ago. And I think if we can see more downside for natural gas, I wouldn't be surprised to see more downside playing out for oil as well. I know there's a lot of talk right now about $100 a barrel. I just
too much talk.
Exactly that, Coach. I think the markets have gotten a little bit ahead of themselves. That's the other one. I'm apart from oil, the other thing where I think markets have gotten way too ahead of themselves is with sterling right now. Sterling it's been a frustrating one for me over the past couple of sessions, because it's a market that I've been bullish from the start of the year on sterling. From that very first pushback we had from Governor Bailey back in January, we were long sterling versus a basket, and it's been a great trade. But the way that money markets have priced in have gotten ahead of themselves with sterling right now. That's got me a little bit worried for the short-term picture for sterling. If we take a look at this screen, this is basically just the SONIA futures. Now, SONIA futures on the December contract for this year is pricing in 44 basis points of tightening. So if we get right now, there's expectations of getting a 15 basis point hike either November or December, whichever one of those two we'll get. But if we take a look at the December contract for next year, sitting at 98.81, that implies a cash rate of 1.2% by the end of next year. So if we account for the current cash rate of 0.1%, if we account for the 15 basis point hike that we are probably going to get in December, That means that the markets right now is expecting the bank to hike 4 times next year, each one of them being 25 basis points. I just don't see that happening right now. I mean, yeah, even though I'm more structurally and medium term, I'm bullish sterling, I do see there's risks. If money market starts to unwind some of this overly aggressive bets, I think that can see some lead to some decent repricing in sterling as well. It's obviously been supported by yields pushing up. It's been supported by SONIA futures pushing lower. So implying higher rates. But I think the reasons why higher rates are being implied, it's not because the economy is doing so well that the markets think the BOE is going to hike right now, right? It's all about fears of inflation. Right. And if you, even though Bailey and Saunders, as well as Pill has come out saying that, as alluded to more of a hawkish tilt, we had Mann coming out last week, we had Tenrero coming out, and they don't seem like they're on the same page right now when it comes to these aggressive expectations. So I don't think there's a broad acceptance among the MPC for where they're going to take rates, and I think that is a risk to money markets. The other thing is that the type of and Bailey has said this himself, the type of inflation that they're trying to fight, it's supply driven, it's energy driven. You can't hike away supply chain disruptions. You can't hike away energy prices that's high. I mean, that's more to the fiscal side that you can try to solve those types of things. So I just think now
you can't print natural gas or oil or corn.
Exactly. I mean, you can't hike to get more HGV drivers. You can't hike to get more truck drivers in. So I just think if they do, I think right now the bar is set so high for sterling that even if they do follow through with a 15 basis point hike, I think that is so far priced right now. If they don't come in aggressively or overly hawkish, that runs the risk of repricing and sterling coming under pressure. And obviously, if they don't, which I don't right now, I can't see them hiking 5 times before the end of next year. If they don't follow through, there's going to be repricing. So I would expect sterling to dip once these money market starts to reprice. But because the medium term outlook is still positive, I would look to buy any of those dips if indeed we get it. I was already wrong-footed on this with euro sterling last week, so I was looking for a little bit of upside as money markets realized that, hey, we've gone a little bit too far, but I got taken out of a buy that I got, which I entered from just above that 84.70. I had a stop sitting just below that recent swing. Below 85.50. So I've got taken out at 84.40. I got into this again because I don't see the markets realizing, the BOE at least realizing what money markets is pricing right now. And the reason why I like
might be turning right here.
I wouldn't mind if it does. I wouldn't mind if it does. But we'll see how it plays out. I mean, The thing is, timing with this, I think, is the biggest risk because we're still a while away from the November meeting as well as the December meeting. And we've got CPI coming up tomorrow. If CPI beats, I would probably look to fade sterling strength on a CPI beat because I think that's just going to create further aggressive pricing. And eventually, I'm hoping eventually money markets will realize, listen, we've gotten way too ahead of ourselves. We need to reprice. And I think that's going to put sterling under pressure. The other risk to consider, though, and I think that's largely been driving euro sterling as well. Not only that, but the euro has been exhibiting a lot of funding currency characteristics over the past couple of months. And sterling, even though it's not a high beta currency, it does have a higher beta compared to the average. I think risk on has also been a negative driver for something like euro sterling. It's been a real hard pill for me to swallow to go long euro sterling because we were short this from January. So making the shift from bearish to bullish has been psychologically hard.
It usually takes longer than we think it does to turn around a battleship.
That's exactly that, Coach. I think these levels offer attractive risk reward. Also because the euro, I think there's so much negativity that's been priced in for the euro. If we take a look at leverage funds is sitting on a sizable net short right now. So I think if we are able to peak above some of these key levels to the upside, that could spark a little bit of a short squeeze. And euro sterling is, it's been whenever we've had short squeezes, they've been violent in the pair. So
yes.
I'm potentially looking at something like that, but it's not just euro sterling. I think sterling in general, I do think the risks are tilted to the downside just because money markets are just too aggressive.
Okay.
Similar to.
So what's the best way for people to follow you? I know your Twitter handle is Arno Venter 1. Is that what you have, or a 9?
I think it's
Twitter?
9. The first 8 was taken, Coach, weirdly enough.
Okay. All right.
So I went with 9. The first 8 was taken. So it's Arno Venter 9, but they can also reach us. Financialsource.co is the website. I think we've got on most of the socials. We've got a handle.
Want to show
on
your
Twitter.
website?
Yeah, sure. Let me quickly.
Before you go. Sure.
Quickly grab that on the screen. Can you see that one, Coach?
Yeah, came up.
So that's the website, and I mean Financial Source. If you search that on Facebook, if you search it on Twitter or YouTube, etc., you'll be able to catch us there. And my own handle, of course, is just Arno Venter 9 on Twitter.
Okay, I'm glad I reached out to you, Arno. It was a great interview. Appreciate you sharing your views with us today, and wanted people to take a look at your service and what you offer, and maybe you get some business out of this. And when you survive an interview with me, you're now my trading warrior brother. That's
fantastic. Thank you, Coach. Really appreciate that.
Yeah, Arno, you have a great you have a happy demeanor for being a trader. So you had an interesting story and some interesting views. I didn't even know about Sonia or whatever that was before. So I learned from you today, and thank you so much for being with us and edifying our community.
It was really just an honor for me to be here, Coach. Really appreciate the time and really appreciate the invite as well.
Okay, you're getting some thank yous from Jachin, Alexander, Monica. So have a great fall trading season, Arno. We'll do it again.
Thank you, Coach. You too. Appreciate it.
All right, everyone. That's a wrap for Turnaround Tuesday. Good hunting. You could join the team in 15 minutes for the morning edge, and I'll see everyone tomorrow. Don't just count your pips, count your blessings. Adios.